You signed your name 40 times, maybe more. Initials here, signature there, a stack of paper thick enough to stop a door, and somewhere in that stack, 5 separate charges quietly left your bank account. You didn't ask what they were for. Almost nobody does. But the real answer is far stranger than a formality buried in fine print. It's a story about how an entire industry learned to make its profit invisible. Start with the first one, the origination fee. Your lender charges you this simply for agreeing to lend you the money at all. In 2008, Rand economist Susan Woodward was hired by the U.S. Department of Housing and Urban Development to figure out why closing costs on FHA loans varied so wildly for the exact same loan. Her conclusion was blunt. Borrowers had no real way to compare prices, so lenders charged whatever the market would tolerate. It arrives disguised as a percentage. 1% sounds small. On a $400,000 mortgage, it's $4,000. And that number isn't fixed by any regulator. 2 lenders can charge a full percentage point apart for the same file, and both are legal. Then there's discount points. The name sounds like a deal. Pay up front, lower your rate. That part's true. But the Consumer Financial Protection Bureau has warned for years that the break-even math rarely gets explained clearly. You might pay $3,000 to save $20 a month. Do you know how long that takes to break even? Most buyers don't, because nobody's required to tell you. And some lenders quietly build the assumption of points into the rate you see advertised online. So the number that pulled you in was never really available to you for free. You went looking for the best deal, compared 4 or 5 sites, and the one that caught your eye assumed a purchase you never agreed to make. Next, mortgage insurance. On a conventional loan, it's called PMI. On an FHA loan, it's called MIP. You're told it protects the bank against you defaulting. Read that again. It protects the lender. You just pay for it. On a conventional loan, once you hit 20% equity, you can drop it. On an FHA loan originated after 2013, in most cases, it never goes away. Not at 20%, not at 50%. For life, unless you refinance. 2 buyers, same income, same struggle to save a down payment, and one pays this forever while the other sheds it in a few years. Which one are you? The Urban Institute has tracked this divide for years, and it holds up. Lower income buyers lean more heavily on FHA loans because the down payment is lower. That same group ends up paying insurance for decades that a conventional borrower sheds in 5 to 7 years. The fee meant to make ownership more accessible ends up costing the most accessible buyers the most for the longest. Fourth, title and settlement fees. This pays to search public records and insure against anyone else having a claim to your house. The Real Estate Settlement Procedures Act, passed in 1974, exists because lenders and title companies used to trade unmarked referral payments, quietly folded into your closing costs. The law limited it. It didn't end the confusion. Here's the part almost nobody knows. In most states, you can shop for your own title company. Almost nobody does. Your lender just recommends one, and it feels official, so you assume it's required. The National Association of Realtors has published data showing that shopping around can save hundreds of dollars. Nobody volunteers that. Why would they? Nobody in that referral chain benefits from you calling around. And fifth, the prepayment penalty. Fewer loans carry it today, thanks to rules the Consumer Financial Protection Bureau put in place after 2008. But some non-qualified mortgages still do. Think about what that means. You get penalized for handing the bank its money back early. Not for defaulting, for succeeding. Imagine paying off a car loan early and getting billed for it. Imagine finishing a gym contract early and owing extra for leaving too soon. It sounds absurd anywhere else. Inside a mortgage, for decades, it was standard because the lender's business depended on collecting interest for the full term. Paying early interrupted the plan, so the penalty protected the plan, not you. So look at what you actually have. A fee for the lender agreeing to help you. A fee disguised as a discount. Insurance that protects the bank while billed to you. A search and insure cost you never knew you could negotiate. and in some cases, a fine for paying too well. None of this is secret, technically. It's disclosed, somewhere, in a stack 40 signatures thick. The Truth in Lending Act was passed back in 1968 specifically to force lenders to show the true cost of credit in plain numbers. More than 50 years later, the numbers are on the page. The understanding still isn't. Compliance was never the same thing as clarity. One satisfies a regulator. The other actually protects you. The industry only ever needed the first one. Think about how the closing table is actually built. You arrive tired, boxes half-packed, a moving truck booked for the weekend. Across the table sits someone who explains these exact 5 fees hundreds of times a year. You're meeting the biggest financial document of your life for the first time. They're meeting it for the 1,000th. That imbalance isn't an accident. It's the reason the pace of a closing feels the way it does. Fast, procedural, 40 signatures deep before you've had a chance to breathe. So think back to that stack of paper. 40 signatures. 5 silent charges. You didn't ask because the whole process is built so that asking feels unnecessary, even rude, at the one moment it matters most. Next time you sit down at that table, you won't be signing 40 times without asking. You'll finally know exactly what you're asking about.